welcome to the Emotional Balance Sheet Podcast, your guide to help you manage life, money, and multiples. Each episode, host Paul Fenner, Tama Capital's president and founder, and the proud parent of 4 amazing children, including 1 set of triplets, will provide insights on successfully sustaining an active lifestyle, career, and family through comprehensive wealth management strategies, financial education, and lifestyle planning, specific to parents raising twins, triplets, and more. Learn more, subscribe to the show, or connect with Paul at tamacapital.com.
This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of TAMA may retain positions in the securities discussed in this podcast.
Are we in a recession, headed for a recession? And does it really matter given that in 2022, we experienced one of the worst performing stock and bond markets ever? How will a continued robust job market, slowing inflation, and higher interest rates impact corporate earnings this year? These are all topics that will have some impact on your portfolio performance this year and potentially into 2024. Jordan Jackson is a global market strategist at JP Morgan. Jordan has authored several papers on the economy and markets and is responsible for conducting research for JP Morgan's Guide to the Markets, which I utilize in managing investment portfolios. Although the U.S. as a whole may not be in a technical recession, if you look at it industry by industry, there are certainly specific sectors that are in a downturn, such as technology, residential, and commercial real estate, to name 2. Jordan and I dive headfirst into what the economic and corporate earnings data may mean to investor portfolios. We also deep dive into how much sleep Jordan is getting as a new father, and he shares the best thing about being a new dad. Please enjoy my conversation with Jordan Jackson. Jordan Jackson, welcome to the Emotional Balance Sheet Podcast.
Thank you for having me, Paul. Excited to be here.
Yeah, I know this has been a long time coming. Well, I guess long time is probably maybe an exaggeration, but we first met at a financial planning conference in Grand Rapids, Michigan, back in September last year, and I was so impressed with your presentation. I'm like, I'm gonna have to have this guy on the podcast. So as soon as you got off the stage, I walked right up to you and had a conversation, and glad we did, and glad we were finally able to get this scheduled. So,
no, I remember it was a great time. It was my colleague Randy Parpar was out there with us, and once we met, I was very much looking forward to the opportunity to join you on the podcast. So again, happy to be here.
Yeah, that was actually, I think, our first FPA Michigan conference that we were back live in. So it was really great to see a lot of people and have great presenters back like yourself. So I think the place I normally start with guests is to introduce yourself, talk a little bit about your background. People probably don't know who you are, but I know who you are from JP Morgan because I've been reading your guys' research for years. So I think, why don't we start there, talk a little bit about your background and how you came into the world of finance, because you have a pretty interesting career transition that I'd like you to tell that story, because if there's one thing about this podcast over the last 2.5 years of hosting it, we talk a lot about life transitions, and you're going through a couple right now as well. So we'll get into that.
Sure. So I'm originally from New York. My dad owns his own dentist practice in Queens, and they're graduates of the University of Virginia. So I followed in my parents' footsteps and went down to the University of Virginia from New York. Charlottesville is a beautiful city, and had a great time there. Actually majored in African American studies and minored in business Spanish. So that's a fancy way of saying I spent a semester abroad in Valencia, Spain, which was really, really exciting, and probably one of the biggest highlights of my collegiate career. I moving into my senior year in undergrad, I got an internship at JP Morgan within their asset management division, really more so focused on their marketing and distribution. And that translated to a full-time offer, also within asset management, but specifically on our consultant relations desk. So I actually started my career facing off with institutional consulting firms Think about, UVA's endowment. They don't have the capacity to have an investment committee. So they go out and they hire an institutional consulting firm to really help out with their portfolio and asset allocation more broadly. And so, my job, again, was to face off with those institutional consultants on those portfolios across endowments, healthcare plans, pension plans, defined contribution plans, really the whole gambit. And so that really allowed me sort of a high level on what sort of my first steps into asset management, how to think about portfolio construction at the institutional level, and really gave me a little bit of insight also onto the alternative side of the business, things like infrastructure, transport, real estate. And so that was really a great sort of first step into the business. Realized I had a love for research, and I grew really passionate about investment strategy and capital markets. And so after about 2 years, I moved over to our market insights team to really do that, really generate the ideas across JP Morgan Asset Management and how we're thinking about the markets, how we're thinking about the economy, where we're overweighting, underweighting different sectors across the markets. And it's just been a great fun, call it last 6 years now on the group. So.
Yeah. And for full disclosure, I get your guys' data every month, every quarter. You guys produce this incredible wealth of information that I use when I'm building my own portfolios for my family office clients, making asset allocation decisions. And also full disclosure, I know I have this somewhere in the recording somewhere, but I actually do use JP Morgan ETF products. So definitely want the viewers to know that. So there's one piece of that story and I wasn't quite sure where I was going to get to this, but I might as well get to it now. But there's one part of that story that you kind of left out that we talked about when we first met was your music career.
Oh, wow. So
you knew I was going to bring that up.
So my first instrument was in the 5th grade. I started on the trombone. Then I moved over to the tuba. I actually spent 2 years at Juilliard's pre-college division. So I remember 13, 14 years old, my mom would pack my 4.5, 5 foot tall self. My instrument was actually bigger than I was in the car every Saturday morning, and we would drive out and I would be classically trained at Juilliard. And then in high school, I moved on to the trumpet, fell in love with jazz, Dizzy Gillespie, Miles Davis, and I moved on to the trumpet. And I actually still have my horn down here in the basement. Unfortunately, I don't play as much as I'd like, but that's certainly one of the highlights of growing up and being musically inclined, if you will.
Yeah, that was an awesome story of how you transitioned from music to finance. So I definitely wanted my audience to know about that. So let's kind of get into one of the questions that I've been dealing with a lot, and I'm sure you guys have as well, is this whole recession talk. And I think a lot of people, the way that they phrase the question to me is are we going to have a recession? And to me, the answer is always easy. Yes, we'll always have recessions. It's a matter of how deep or shallow they may be. But I think the one thing that's really interesting that's going on now, and I'd like you kind of dive into this, Jordan, is it seems like the recession's happening on a industry by industry basis. So there's a lot of headlines out there with the tech industry, like the Googles, the Microsofts, the Amazons of the world, having all these cutbacks. But then you look at, the energy sector still booming, transportation sector still doing well, industrials still doing well. So it's kind of like a tale of two worlds. I mean, if you're in the tech industry or the, residential or commercial real estate markets, you're probably in a recession and feeling the effects of that personally. But if you're in another industry, you may not be. So walk us through like what you're seeing from that perspective, from a recession, and kind of give our viewers, does it really matter if the whole economy is in a recession or if it's just sector specific, like I just kind of laid out?
No, though that's almost spot on. As I try to remind our investors and our listeners that the median American worker is only about 38, 39 years old. And so professionally, most folks only really remember the pandemic recession and the global financial crisis. I mean, these were two multi-generational type of recessions that really got squeezed into, less than 15 years apart. And how I think about it is if you go back further than that, we've actually had more garden variety, shallow, murky type of recessions. And I think that's sort of what is beginning to play out. I think about the recession of the early 2000s, for an example, where, the peak in the unemployment rate was only at around 6%. And right now we're at about 3.5% on the unemployment rate. But, what you highlighted, I think, is exactly what we're seeing is where some parts of the economy are coming under pressure and other parts of the economy are still booming. We're seeing a lot of headlines around technology, for an example, as a sector. These large companies, they only actually account for about 2% of the overall workforce. And so, if we actually were to scrap all the tech jobs in the economy, you'd actually only see about, call it 0.5% move higher in the unemployment rate. And so you could certainly make the argument that coming out of the pandemic, the tech sector really overhired. And so in many cases, they're really sort of trimming the fat at this point, given just about everybody sort of expects a recession. And I guess that's maybe the last point that I would leave on is this seems to be one of the most telegraphed recessions. Everyone seems to be expecting a recession hitting the economy sometime in 2023. And so in terms of from the markets, right, I do think markets have more or less kind of sniffed this out, the probability of a recession. It does matter, right? I think what would matter for investors is sort of the volatility associated around markets and recessions. Now, we know markets tend to bottom before a recession actually hits. Historically, that tends to be the case. And then it starts to, price in some little bit more optimism, right? Coming out of a recession. But once the recession actually hits, markets are probably going to be pretty choppy, and you'll probably see a bigger dispersion amongst sectors that are going to be hardest hit as a result of what the recession actually looks like. So it does matter, but from a longer run perspective, investors who have a longer term approach to markets, stocks are on sale. When markets were high flying in 2021 and valuations were at 21, 22 times forward earnings, and now things are at 15, 16 times. Again, stocks are on sale and they look attractive for longer term investors.
When you're talking with other investors, both maybe, on the personal side, or I know you deal more so with the international side, that's one of the reasons why when your data comes out, I dig into it, because I think the normal, the everyday investor out there who's getting their financial news, if you will, just from the headlines, and there's so much saber rattling around this recession talk. But when you really get into the details of the data, it's really not that bad. Now, granted, again, if you're in one of those, industries that's hard hit right now, whether it's a tech sector or, I've had, numerous, families that I work with, go through layoffs over the last 6 months because they work in the mortgage industry. Talk about like how you necessarily have that conversation with people about, look, the headlines could actually be, worse than what the reality is actually saying.
Well, that's one of the reasons that, we use our guide to the markets. We really try to provide a clarity amongst a complex array of issues and headlines. And so it's for us, it's more so about leaning on the data, not necessarily, again, the headlines, as you mentioned. And in many ways, that ends up dispelling a lot of myths throughout the economy. But the way I sort of deal with this problem is, coming out of the pandemic, you had a large amount of stimulus hitting consumers. Now I think the everyday consumer feels like they have, or citizen, they've got a little bit more selectivity in that next job. I think they feel they got a bit more bargaining power, just given the lack of labor supply that's out there at the moment. And so it's just been really hard as a business owner to find work. I mentioned my dad owns his own dentist practice in Queens, and he's had challenges just trying to find a capable and qualified dental assistant. And this has really been a challenge over the last, call it year and a half. And I think it's going to continue to be a challenge in the years ahead. And so, a lot of different sectors of the economy are feeling this labor supply shortage. I think the everyday citizen feels they got a bit more bargaining power in terms of what that next job looks like, and even the wages that they maybe should be demanding from their employers. And so there's this tug of war, right, between business owners trying to be able to find qualified labor at a cost that makes sense for their business, while consumers have maybe a little bit more bargaining power in an environment in which there's just a lack of qualified workers in the economy today.
Let's pivot to the other hot topic when it comes to the everyday consumer. And I had Cullen Roche on my show back in December talking about inflation. More than likely, we probably have seen peak inflation, but that doesn't mean people still aren't feeling it. I mean, here in Metro Detroit, gas is back over $3 a gallon. It seems like the hot topic these days is the cost of eggs. I heard out in California, a dozen eggs is going for like $8 now. What are you guys seeing on the inflation front? I mean, obviously the data is showing that it's still coming down, but given that we're still at such elevated levels that we were accustomed to over the last, decade or so, what's your guys' take on that?
No, it's interesting because sort of how we were talking about how parts of the economy were under pressure while other parts were doing well. Parts of the inflation, components of inflation, some are still running hot while others are starting to subside. And so some of it is, the calculation, right? The methodology that the Bureau of Labor Statistics uses in deriving the CPI baskets or the inflation baskets. But right now, where we're seeing most of the either disinflation or outright deflation is still in energy, with gas prices certainly down off of their peaks from the middle of last year. Other parts core goods, right? Remember coming out of the pandemic, everyone bought a whole bunch of stuff.
Yep.
And you couldn't, and it took forever to come in. Things are finally able to, order something and order a coffee table, and it's finally getting in at a reasonable time. And, it's not, probably as expensive as it was back in the tail end of 2020. So those prices are coming down. But where we're, still seeing a bit of the inflationary pressures are at grocery stores, are at restaurants, food, being one of those elements that prices continue to inflate. And also still, even though, housing is coming under pressure, we're still seeing sort of, shelter costs and rental inflation that's still running pretty hot. And so, while, if you probably signed a lease in the last month or so, you probably have noticed, maybe leases are starting to roll over, but they're still somewhat elevated from, certainly where we were prior to the pandemic. And so, again, there's components of inflation that are still running hot, some components that are actually beginning to cool. And that the cooling components of inflation have really helped to get us past the peak inflation rate. And we're finally starting to see inflation move down. As of last month, you've got inflation that's running at about 6.5%. Remember that peak inflation rate was at about 9%. But remember, inflation is measured on a year-over-year basis. So when we look at some of the month over month, we're seeing, again, some of those components starting to come down, but also still seeing things like housing and food inflation still running a bit hot.
Yeah, I think for most people, when they go to the gas station, they go to the grocery store, they see that day in, day out, week in, week out. And I think that has a impact on people's mindsets of, how much they're spending, where they're spending. So are you guys seeing in the data at all, like any pullback in discretionary spending? Because, you look at the travel industry, that's still smoking hot, like trying to get on a cruise ship or trying to book a plane. Disney has had their struggles, but go to a Disney park and it's still packed.
No, it's interesting. We haven't necessarily seen discretionary spending beginning to roll over. It's just really where the source of where that spending is coming from. And so, whereas coming out of the pandemic, the population was using the unemployment checks, they were using enhanced unemployment insurance benefits. They were using, again, those one-time checks that were distributed in order to fuel a lot of that spending. Now they've, maybe dipping into some of their savings accounts in order to fuel some of that spending, or they're ramping up some of their credit card balances in order to fuel a bit of that spending. So, it's shifting, but we're seeing consumption remain still pretty robust amongst consumers. And I think part of the reason is because you got just this really, really tight labor markets, right? And we've kind of talked about this, but the idea that, most people, if they want a job, they either have a job or can find a job pretty quickly in this environment. And so with the exception of some of the sectors that we talked about, like technology and housing. But I recently bought a home in DC last year. Well, actually now not last year, the year before last, in 2021. And we were doing a little bit of work done, and we couldn't find a plumber. Right.
Right.
But now you can certainly find a plumber. So, I think things are getting a little bit better. And while inflation is starting to roll over and come down, we may be in a position in which, incomes finally start to outpace the rate of inflation. And that would put consumers in a pretty good spot in terms of their spending down the road, over the next couple of quarters.
So one of the things I'm still having a hard time getting my arms wrapped around is this the strong labor market. If it remains tight to some degree, is that going to continue to put pressure on inflation and keep cost high?
Yeah. So as we think about the feed through, inflation is a function of the prices that are set by companies. Right. You go to a restaurant or whatever, you go to your grocery store, right? Those prices are set by Walmart, except Target, whatever have you. Now, of course, those companies have to employ people and they have to pay them wages. And typically, wages are the largest share of a company's expense. And so the feed through is if I'm a company and I have to pay more for labor, which is already the largest cost on my balance sheet, then I'm going to have to charge more in order to protect my profitability, to protect my margins. And of course, I've got a duty to my shareholders who own a share of the stock. And I want to report good earnings. In order to do that, I've got to protect my margins, right? Manage my bottom line, those costs, while still being able to generate revenues. And a big piece of that revenues is pricing power, right? Being able to price goods and services in a way that's profitable to our business and profitable to our shareholders. And so what the concern is, you get this, what economists will call a wage price spiral, right? And this notion in that a tight labor market generates persistent higher wages, where companies have to continue to try to pay more in order to attract that additional worker and generate additional output, and thereby having to charge higher prices in order to meet that demand. And that's how you get this wage price spiral. It was very much evident in the 70s and the 80s when you had a very strong union membership. You think about it was the union going up against J.P. Morgan, not just Jordan Jackson trying to lobby for higher wages. And so there was just generally more bargaining power. But I think in this environment in which supply is just so tight, we could very well stay in an environment in which finding that additional worker is going to continue to be a challenge. And maybe prices continue to move down, but it does suggest that maybe inflation can kind of run at a persistently higher level than what we might have been used to over the past decade or so. You think coming up to the pandemic, inflation really only ran at around 1.5%, year over year consistently. Now with this lack of labor, maybe we step into an environment in which inflation sort of runs between 2 to 2.5%. just given this persistent lack of labor supply and this wage inflation kind of feeding through into a higher overall inflation.
I think that's actually a perfect segment into the next question I wanted to talk about, which for a lot of my family office clients, they hear me talk about corporate earnings trends a lot because I base that, that's a foundational piece of the asset allocation decisions and when I'm choosing to buy or sell a company within our portfolio. Right now, it seems to me that corporate earnings still have the ability to come down because they may not have, experienced all of this cost pressure that we just talked about. Are you guys seeing that in the data? Are you guys expecting, corporate earnings trends to come down this year?
Yes, we are expecting earnings estimates to really begin to come down. Right now, markets are pricing in roughly 4 to 5% earnings growth over the course of 2023, and in an environment in which, at best, we're looking at a slowdown in the overall economy. At worst, we're looking at an outright recession, albeit a modest one. Earnings tend to be hyper-cyclical, meaning they tend to move to a greater degree than what the broader economy is doing. And so if we're talking about a mild contraction in the economy, that would suggest earnings will need to contract to the tune of around down 10 to down 15% over the course of this year. And that's just not being appreciated in stock prices today. So go ahead.
I was just going to ask, because I've made this point with some of my families, is that given that pressure, does that mean that the stock market has it could go another leg lower? I mean, we just had this 20% plus correction, depending on what index you look at, whether it's S&P 500 that was down almost 20% last year, the NASDAQ, down over 30%. The Dow actually did the best. But does that earnings pressure, will that put additional pressure on stock prices needing to come down?
Yes. I mean, it certainly goes back to the volatility that we talked about, right? And so just the magnitude of moves that you'll see in the market, we're knee deep in the reporting season. We just had a couple of the big banks beginning to report fourth quarter 2022 earnings. But really importantly, again, markets being forward looking, they're going to be looking at the forward guidance that a lot of these CEOs are going to provide in terms of what they expect their earnings growth to look like over the next 4 quarters. And that will really help analysts to fine tune some of those earnings estimates. And that's why we think some of these revisions, we're going to see net downward revisions, earnings estimates, again, beginning to roll over. But as we continue to talk about, this is not, sort of an economy, a labor market in which you just paint one broad stroke and that sort of defines the state of play. Typically, what you tend to see are more defensive sectors like healthcare, utilities, consumer staples. Their earnings revisions tend to be a lot smaller than what you would see in sectors like energy and technology and consumer discretionary. So in an environment in which, earnings estimates may come under pressure, they're probably going to do it more so on the more cyclically orientated parts of the economy, right? Those parts of the market that are more sensitive to economic activity and being able to generate, revenues when consumers are spending. But the reality is, if we're sick, we're going to continue to go to the doctor. We're going to continue to pay our utility bills, right? We'll cut back on discretionary spending, but consumers will do all that they can to continue to keep the lights on. Right. And so those sectors, those parts of the market tend to hold up a bit better in a recession.
So I think it comes back to one of the points I think we were making before. It's really a tale of two economies, if you will. It really, you really need to deep dive into sector specifics and not look at it, as a whole, because you can get a very distorted picture.
No, that's exactly right. And so, even within our portfolios today, we're still leaning a bit more defensive, just because we're not, we have an idea, of course, but we can't say definitively how the recession is going to play out. But as I mentioned, right, people are still going to pay for their toothpaste and their toothbrushes. And so, we're just leaning a bit more defensive within our equity allocation. But again, as we talked about, markets and the economy tend to be on different sleep schedules. And as a new dad, I getting on a good sleep schedule is the hardest thing right now. But with that in mind, I do think once markets kind of tease out what the nature of the recession would actually look like, the depth and severity, it'll price that in, and then it'll start to look forward to some optimism in 2024, potentially when the Fed steps in and maybe provides a little bit of accommodation by more easier monetary policy.
Are you guys pricing that in at all? I mean, in the headlines we call it the Fed pivot, if you will. Are you guys thinking that could happen sometime in 23 or not?
So the Fed seems pretty committed to lifting rates to at or slightly above 5% by the end of the first quarter of this year, and keeping rates there for a period of time. And we think a period of time means the duration of 2023. Now, maybe they're pushed to the December meeting of 2023. Maybe that's when they start to cut. But I think they're pretty committed to try and not start cutting until 2024. And that's when we get the pivot. But again, markets are forward looking, so they may start to signal that they'll start cutting rates maybe in September. And I think at that point you'll see markets really rally and take off, given the expectation that the Fed again will start to ease up on their hawkish rhetoric and be a bit more accommodative in 2024.
And that's where I think we share the same thesis on this, where we could see a lot of volatility here in the first 6-7 months of the year, and then towards the back half of the year we could see potential rally, if you will. Even though it's a head scratcher right now, Jordan, like the S&P's rallied 4%, 5% so far this year. And that's puzzling to me.
Yeah, well, a lot of it is certainly rate driven in terms rate. I would say rate and inflation driven, and given a sense that we've gotten a couple of inflation prints that suggest that inflation is coming down. And that would suggest that maybe the Fed doesn't have to hike until 5%. Maybe they hike until, 4.75 to 5% on the Fed funds rate and just cool out there for a little bit. And I think, markets are sort of cheering that probability. You've seen rates also come down so far this year as well, both short rates as well as long-term rates. And maybe that's one of the things that we haven't talked about. While, stocks are, may very well be choppy and volatile in the earnings backdrop, you've also seen a huge reset on the bond side of things in terms of valuations. And so the way I'm sort of thinking about this, and this is different for every client, but you can now use, short rates. You think about a 6-month CD or a money market fund for income. You're able to get, between 4 and 5%, depending on where you shop. And you're able to, if you're particularly concerned about a deeper recession, you can use longer term interest rates, think 5 to 10 years in a treasury bond as insurance. So short rates for income, long rates for insurance, and that's out of how you can play the bond market. And I wouldn't be surprised after a horrible year in bonds, one of the worst years, probably the worst year on record, that bonds perform better than stocks in 2023.
Yeah, I'm actually glad you brought that up, because that's been something that I've been reintroducing to my families I work with, is getting back into the bonds, and especially treasury bonds and CDs that you just mentioned, because I think for the last, up until recent now, there was this acronym TINA. There was no alternative to stocks, like, getting 0 to, less than 1% on a CD or a savings account, or even a bond for that matter, wasn't worth the scratch, if you will. But now there is. And so I've been really interested in building the fixed income side of portfolios out just as much, if not more so than the equity side, because we waited for this for a long time, but to get here, most people don't realize to get that 4.5% rate or 4% rate on a 2-year treasury note, the bond had to go down 15% last year to get there. So
no, absolutely. And this is last year, I think, was the nail in the coffin in terms of exiting ultra easy monetary policy. You think about the last decade prior to the pandemic, interest rates spent most of that time at basically zero. The real cost of capital was negative. You could borrow for what felt like free, right? I mean, I think about being able to buy my home at 2.5% 30-year fix. People would
crazy.
People laugh and say it's almost for free. Like, getting a mortgage for free, right? A home for free, but and now we've moved away from that, right? The Fed is now withdrawing liquidity from the market. They're raising interest rates. They're moving out of what I think capital markets got very comfortable with in terms of just easy lending and cost of capital type of environment. And so, last year, a 60-40, 6% stocks, 40% bonds was down about 16%. You have to go back to 2008 in order to get a year that bad for a 60-40 portfolio. And in fact, you've got to go back to 1974 to go back to a year in which both stocks and bonds were actually negative. And so I think 2022 was really sort of that year in which, capital markets said, well, we are going to be stepping into a new investing regime. And as a result of higher interest rates, these asset values will need to be repriced. And so that's what I think you saw happen. And now, as an investor, we look at this as creating a lot of long-term opportunity, whether it's in growth stocks, whether it's in value stocks, and also particularly on the bond side, because again, this movement in interest rates, that inverse relationship between an interest rate on the bond and the bond price, that moved higher in rates meant bond prices went lower, and that's how you got that negative return. We may be stepping into an environment in which the inverse happens over the course of 2023. So, maybe that 60-40 portfolio looks a little bit more like a 55-45, right? Or maybe even outright 50-50, given the prospects of potential move higher in bond prices, move lower in bond yields as the Fed talks about potentially stop raising rates and maybe turning the corner over the course of this year.
Yeah, and I'm glad you hit a point there. I just want to come back long term. I know that a lot of our conversation today has been focused on what's going on in the here and now, but there comes a point where we need to remind ourselves. I need to remind the families that I work with. Everybody's time horizon is different. Like if you're a retiree, you're not looking like 10 years, 12 years, 20 years down the road. But if you're somebody like me that's in my mid to late 40s, I still have a very long runway to go. And so I think it's really a pointed effort that needs to be made, that everybody has their own time horizon. But if you have a long time horizon, these are blips on the radar screen. Like we have, as I tell my families, we have 100 years of history on our side that, through wars, famines, recessions, pandemics, you name it, the market tends to go higher. But there will be bumps and noise along the way. And that's what we call the price of admission.
Exactly. I mean, volatility is the price we pay as investors. And the beauty is over time, you benefit from things like compounding. You benefit from not trying to time the market, but, generally speaking, buying stocks when things are cheap. And so, again, I think it's just sort of these everyday principles that I think are really important to investing and to really help people reach those longer term investment goals.
Well, I could keep talking this with you all day, but I know you need to get back to your day job and mine as well. But you had brought up the fact that you are a new father. I think you said your daughter, right?
Yes, yes.
Daughter's about 12 weeks old. So as most people know with this show, my closing question is, what is the best thing about being a parent? And you're coming at this very new. So I know we will have further future conversations. So I know I'll be asking you this again, but any first initial thoughts on that question?
It's interesting because, I turned 30 last year, and you spent the last 30 years really more or less focusing on myself, right? My career, what I'm doing in my life. And now you've got this perfect little person that's yours, that is worth almost what feels like all of your time and energy. And so I guess just this period of selflessness, if you will, has been, I think, eye-opening, humbling, as well as rewarding for myself and my wife as well. And so I think I would say that's sort of what I'm getting out of being a parent today. It's wild. We're still counting in weeks, right? And she gave us 4 hours last night, so we were super excited to be able to sleep 4 consecutive hours. But it gets better every day.
That is awesome. I love asking that question to all the parents I've had on, but especially with new parents like yourself. It's awesome. It is. I think my wife Teresa once told me, or she tells other people, it's the hardest job you'll ever love.
I like that. I categorize it as sort of this is the happiest tired I've ever been.
That's a good way to put it. Well, Jordan Jackson, thank you so much for being on the Emotional Balance Sheet podcast. And I know that we'll be having conversations to come.
Awesome. Thank you for having me, Paul.
Thank you for listening to this episode of the Emotional Balance Sheet podcast. Please visit tamacapital.com to subscribe to this podcast or to connect with certified financial planner and registered investment advisor Paul Fenner of Tama Capital. And please join us again next time on the Emotional Balance Sheet podcast.